Welcome to this latest update on the Casterbridge Managed Portfolios. I will talk about markets and the latest changes we have made to portfolios. Since April, markets have experienced both turbulence and strength. A sharp equity sell-off early in the year due to US trade tariffs was quickly followed by a rebound that pushed major indices to new highs by midsummer. In the US, ongoing investment themes such as AI have supported equity markets. In Europe, increased fiscal spending in Germany on defence and infrastructure has bolstered sentiment across the region. In the UK, the FTSE has also reached record high levels. But beneath the surface, there are reasons for concern. Equity valuations, especially in the US, are now expensive by historical standards. At the same time, questions over persistent inflation, large fiscal deficits, and policy uncertainty means volatility in markets should remain elevated. The US dollar has also been weaker and more volatile in recent months, adding another layer of complexity for investors. Against this backdrop, we have kept overall asset allocation unchanged, but have made important adjustments within equities, fixed income, and alternatives to ensure that portfolios remain resilient. So starting with equities, valuations at the broad market level remain stretched, particularly among larger US companies with high growth expectations. Many of these companies, particularly in the technology space, have been investing heavily in AI. While this may support earnings growth in the future, it leaves valuations vulnerable if the high expectations are not met. By contrast, themes we are more constructive on at the moment include smaller companies, mining equities, and emerging markets, which trade at more attractive valuations and offer stronger long-term return potential. So within portfolios, our allocation to US smaller companies has delivered strong returns since the last rebalance in April, with one of the new funds we introduced in high-risk portfolios gaining over 30% in just 4 months. Part of this has been driven by the Federal Reserve's recent signal to cut interest rates in September. So given the strong performance recently, we have taken the opportunity to bank some profits selling one of our US smaller company funds and reallocating to strategies with more defensive characteristics. This ensures we retain exposure to the long-term opportunity in smaller companies while reducing risks and adding balance to the portfolios. In the UK, we continue to run a barbell approach, combining exposure to larger, attractively priced companies with a dedicated allocation to high-quality, smaller companies with exciting growth prospects. This balance allows us to benefit from the relative value in larger companies with stable earnings growth while still capturing the long-term potential of smaller, more dynamic businesses. Globally, the key change in medium to high-risk portfolios has been an increase in exposure to gold and silver mining equities. While these assets have already delivered strong returns recently, we believe commodity prices are likely to remain elevated, improving company earnings and cash flows, and ultimately higher equity prices. This allocation not only diversifies our overall equity exposure, but also acts as a natural hedge against both geopolitical tensions and broader market risks. In Asia and emerging markets, we have sold 2 lower conviction funds and reallocated capital to broader, more consistent strategies with a tilt towards larger companies at attractive valuations. These changes mainly impact higher risk portfolios, and the new funds pair well with our other 2 emerging market strategies in portfolios, which are invested in smaller companies with high growth potential. We remain overweight in emerging markets, reflecting our constructive long-term view of the region. The combination of stronger economic growth prospects, the ability for skilled active managers to exploit market inefficiencies and uncover under-researched companies continues to support our positioning. Within fixed income, our key concern is rising yields for longer-dated bonds, and that credit spreads could widen from current levels, leading to prices falling. With elevated fiscal deficits, sticky inflation, weakening confidence in governments, plus concerns over political pressure on the Federal Reserve, we expect yields to remain under upward pressure and volatility to persist. We have highlighted these risks for many years and continue to minimize exposure to fixed income in general. From a bottom-up perspective, we have further diversified our government bond exposure in lower risk portfolios to reduce currency risk relating to the US dollar and have added a new global active fund to take advantage of the volatility across major government bond markets. Due to our negative view on fixed income, we maintain our overweight position in alternatives. Our blend of absolute return funds continue to deliver attractive returns with low volatility and minimal correlation to equities and fixed income. The smooth return profile of mid to high single-digit returns in all market environments is the exact outcome we're looking for to balance portfolio risk and to provide protection during risk-off events. Nevertheless, there's always room for improvement in terms of our blend of alternatives, and as such, we have added a new global equity market neutral hedge fund to further diversify our exposure. This quantitative-driven strategy has delivered consistent returns in recent years, and we believe it will continue to do so. So to summarize, although our overall asset allocation hasn't changed, we have made important refinements, trimming but maintaining our overweight to smaller companies, increasing diversification through gold and silver equities, managing bond risks by minimizing exposure to longer-dated bonds and currency uncertainty, and enhancing our alternatives mix with strategies that smooth portfolio returns. These changes leave the portfolios across all risk profiles well positioned to navigate elevated valuations, inflation uncertainty, geopolitical risks, and policy shifts in the months ahead. Thank you for watching. We look forward to updating you all again soon.